what's available in Brisbane at the moment is we'll buy a bunch of properties this week for 300K through to 600 grand where this strategy is available on. And then in 20 years time, they'll be worth more. And that window of cash flow and growth in this city will shut like it did in Sydney.
Yeah, and you're going to have to sacrifice one or the other like we have historically had to do.
As an investor, I have two very different strategies. Now, one of them is to buy extremely high quality blue chip assets that achieve very strong, hopefully long-term capital growth in Australia's best cities. And then I have a second strategy, which is accumulating houses and adding secondary dwellings, also in great locations, but with much, much stronger cash flow. Now, I know as investors, we're constantly asking ourselves that question. You know, let's say you can borrow $1 million. Should I go and spend that $1 million buying one really good place? Or should I split that into a couple of properties? And that's exactly what we're going to break down in today's video. So we'll be talking about some of the pros and cons both ways. Again, I don't have a particular way. And as a business, we help people do both. I think a balanced long-term portfolio probably includes a little bit of each.
Definitely, and that's, you know, what both of us are executing as well. I've got a couple of more affordable properties that are going to provide me with really strong cash flow, and these are the ones that are going to enable me to actually achieve financial freedom. So to me, I'm leaning more towards the two properties, but then obviously you've got some really high quality single income blue chip properties that are obviously going to outperform the capital growth of my properties. So, you know, I think having that balance is really important. But let's start to break down some of the pros and cons associated with buying that expensive blue chip property.
You know, so if we look at this little list that we've created, our little Robert Kiyosaki quadrant, some of the positives is just in terms of blue chip stuff, the potential or above average potential for capital growth. Now, you don't have to look back at much history to see Sydney, Melbourne, Brisbane, Perth have all done around about 9% per annum for the last 50 years if you just get the total number and divide it by 50.
Yeah.
So those are the markets that have worked, and that's where the population, the jobs, and the high income earners live. That makes sense. Now, when we're talking about blue chip areas, we're talking, to me, Sydney, Melbourne, Brisbane, maybe Perth, the surrounding, you know, Central Coast, Newcastle's, Wollongong, Sunny Coast, Gold Coast, Geelong's type things, Mornington Peninsulas. So they're the blue chip parts of Australia.
Closer to the city generally, or closer to the beaches, is generally where you find those more expensive properties as well, and those ones that have consistently outperformed other areas.
Completely. Like, the closer to the city you are, and Michael Matusik's done some research on this, generally the most expensive parts around the world are the places within 5Ks of the CBD, or the places with ocean views or walking distance to the beach. So, you know, I obviously wasn't always able to buy those types of properties, and I still can't. Like, I've still got properties that I'm trying to find the balance between. Like, I don't want to go and spend $2 million on every asset. I want quality stuff. And so as an investor, we're constantly towing that line of, like, you know, what works versus what we can afford as well.
And, you know, a good thing to do is kind of understanding and unpacking where it is that you want to be in the future, what your long-term goals are, and then reverse engineering that back to what should I be doing next in order to get one step closer to there. So having that long-term strategy makes this decision a hell of a lot easier.
The next one is demand. So generally these blue chip high quality areas have stronger demand from mums and dads that want to live there. They also normally have a higher percentage of mums and dads living in them than investors, and therefore people spend money, they renovate places, they knock down and rebuild them, and they add value, and therefore the land values are higher, which over time results in much higher property prices.
Yeah, and I like the fact that those demographics are generally a little bit stronger, which makes life a bit easier for you. So you don't generally have to worry about having average tenants in there that might ruin the property or not look after the property well, or not end up paying you rent or something like that, because the types of demographics that you're attracting and that you're appealing to, generally the higher income earners that want to live in the area due to the school districts or, you know, social status, whatever it might be.
It's so funny. Like, I've got friends of mine that live in Brisbane and Sydney, for example, and there's such stigmas around certain suburbs being better or worse than others. A lot of that stuff sort of washed out in Sydney over the last 15 years as just everything's got expensive. But in Brisbane, it's kind of like this suburb, which is the same distance as this one, is just seen to be a Mercedes and that's a Toyota for no reason, except that that's the way that it has always been and we haven't gone through that big spike yet.
I guess you got to compare it to like a Maroubra or a Redfern in Sydney, where these areas 10, 15 years, well, maybe more than that, 15, 20 years ago were pretty average, but now they've obviously become some of the most desirable locations in all of Australia. So, you've got to understand that gentrification will come.
For sure. In terms of, just having one good asset, it's simple, it's easy to manage as well. So you've just got that one asset to look after, and I completely understand that's why people go. I used to think that the goal of being an investor was who has the most properties wins, but it's actually the complete opposite of that for me now. It's who has a great portfolio that is easy to manage, that produces great cash flow and achieves long-term growth, and allows you to live the best life with the most choices as soon as possible. So for me, I get the simplicity of this strategy, and that's why I like these types of properties in my own portfolio.
Exactly. It's trying to find that balance to get the compound growth, because sometimes it's not about the amount of property, well, all the time, it's not about how many properties that you own, but the value of those properties and what that potential can be from a capital growth rate over the period that you hold the property.
Now, if you jump on Google and just type in compound growth calculator, and you were to put, let's say $1 million into a great suburb that grows by an average of 7% per year for the next 30 years, you'll get a number. I'm not sure what that is. And then if you were
a high one,
yeah. I mean, effectively, it's going to triple in value almost. Over the same period of time, if you were to put that same $1 million into two cheaper properties that only grow by 5% a year, again, you're still going to get an incredible number over 30 years. But the reason people go for blue chip is that difference, that 2% per annum, which over the long term on big money ends up talking about hundreds of thousands of dollars of difference in long-term wealth position. And that, again, is a big reason why people do go quality.
But there's always negatives, there's always cons with any strategy, and same for blue chip. Now, some of the things that that a lot of people don't like is the fact that it is extremely expensive to get into a property that's blue chip. Basically in a capital city in Australia or a major regional market, to get blue chip that we're talking about, you're not getting much change for $800,000-$900,000 right now. So costs you a hell of a lot more money to get in.
Without a doubt. Obviously, the cash flow is not as good. So the way that property works generally is, and I'm talking about on the normal rental market, the higher the value of the property, the lower the rent return on it. The cheaper the property, generally the higher the rent return on the property. Is just a simple rule of thumb, and you see that all across the world.
Yeah.
Now, cash flow is extremely important. In today's interest rates at 3-4%, it's easy for a lot of people to lose a couple of $100 a week and still keep their head above water. But what happens if your interest rate goes from 3% to 7%? Yeah. When your interest rate goes back up, which has happened, you just have to look at long-term history sitting at about 5-6%. So that can really have a financial impact on households, and that's when people get themselves into trouble. So that can be a massive downside to just having one great asset.
Exactly. And generally what you find is there's more volatility with these expensive properties. So they'll have higher highs, but they'll have bigger lows as well. And, you can see this in the eastern suburbs of Sydney in 2018 when it had a bit of a correction there. Those markets were dropping by higher percentage rates, but it's just because those properties were so much more expensive. But if you look at the highs, they've generally got higher percentage rates as well.
The reason that happens is there's a lot of Australians, let's say the average household income's 80K or 100K, whatever it is now, that can afford a 300K to 600 grand property quite comfortably without sacrificing lifestyle. But when you look at the higher markets, the Bondis, the Port of Melbournes, the Fremantles, whatever, the Geelongs, there's significantly less people to transact on a $2 million property or $1 million property in the average market, let alone a market where people are fearful and want to stop spending. So it's just something to know. You will get that volatility, which is fine. One of the other big things to me is risk. I'm always trying to manage my personal downside risk. And so the risk of having one great property with one tenant in it in retirement is you lose that tenant, or it's a bad market and your rent has to drop significantly just to fill it, then you're significantly disadvantaged from a cash flow perspective. And if that's what you're living off, that can be really, really rough for people at certain stages of their life cycle.
And for me as well, the last one is debt. Now, I want to achieve financial freedom, and the way to do that is generally to own properties outright. And if you've got a lot of higher value properties, it's going to take you a lot longer to pay off that debt on the properties as well. So keeping that in mind of how long it's actually going to take you to reduce the debt on the property.
You know, that's a really important one, which you can get into with your financial advisor or your accountant, but it is something we think about because we do want to own properties outright. We're not trying to buy 100 of these things. We just want a very small number of good things that enable us to have some choices with our families in 15 years instead of 30 years.
Now let's talk a bit more about two dual income properties. Now this is a strategy that we talk about a lot. We've just actually recorded a podcast, which is also on the YouTube channel, about our two properties to financial freedom strategy. I recommend going and checking that one out. But once again, there's always pros and cons associated with that strategy.
Now that simple idea, if you haven't heard it before, is you buy two houses and then you add two tiny homes or granny flats or secondary dwellings onto them. So effectively, instead of spending that $1 million on one big expensive joint, you have two houses with two granny flats and 4 incomes. And if I just think about one of the major advantages of this is if I lose my tenant in retirement, on one of the properties, I'm still getting 75% of my income versus losing my tenant in retirement on my one expensive property. I'm getting 0% of my income. So Ray Dalio talks about this best in his book Principles. Tony Robbins talks about it in Money Master the Game, or I think it's Unbreakable or Unshakable.
Unshakable.
Great books if you want to learn more about that stuff from actually people that are licensed to talk on it.
So the first and probably biggest pro to me is the cash flow, which is generally a little bit better when you're going for lower price properties.
For sure. So let's say that instead of spending $1 million and getting $600 a week of income in the first example, you go out and spend $350K and get $350 a week rent from that. Then you go out and spend $150,000 on the granny flat, for example, and get another $320 a week on that.
Yeah, so it just essentially lowers your risk. So for when those interest rates do rise and it costs you more money to hold the properties, you've got that increased income to hold on to those properties for longer without them affecting your situation as much.
You know, I love personally as a low risk investor just having that buffer, as Simon talked about. Like when interest rates are at 3 or 4%, and I've got my rates on interest only like I do at the moment, every single week these properties are producing a surplus amount of money, and then I can take that money and I can do with it what I wish. But what I'm doing with it at the moment is just paying off that debt so much faster.
And what I'm doing with it is using it to boost up my savings so I can continue going while I'm in the accumulation phase as well. So you can use it in two ways, whether it's to pay off the debt faster or whether it's to speed up to buy more properties.
You know, there's so many different areas in Australia where a strategy like this is possible. I know they're flirting with the idea in Victoria at the moment and running a pilot program. I know the state government in New South Wales stepped in a bunch of years ago, like 10 plus years ago, and said you could do these as long as you comply. In Queensland, it's council area dependent and a bunch of the councils like it, some of them don't. I think in Perth, it's the same thing. Same with Adelaide, same with the NTs. So this type of strategy isn't one that you just go rushing in and hoping that it works. You really want to consult planners, local councils, and everybody else to make sure that it's something that works. But for us, like, it's an incredible strategy, and we don't want to sacrifice growth. That's what I wanted to make sure we sort of were putting it in either the growth box or the cash flow box. But with our particular version of the 2 houses and 2 granny flats, we want to be close to the CBD or close to water. We want to be on a great land size in a great suburb with a nice big front home that's super appealing, where lots of mums and dads live, with great infrastructure, great schools, great job prospects, high incomes. And so Simon and I are sort of going for a blended version of this, which is great cash flow and great growth, and trying to get everything on the same deal.
Yeah, and you really need to understand timing to be able to do that successfully as well, so that you are buying into the right markets at the right time, right suburbs within those markets. So it can get to a little bit of a deeper level, but if that opportunity is out there to go for both of them at the same time, you know, I'm going to do everything that I can, which I am, to try and take advantage of this. I guess, you know, an example of that is talking a bit more about Sydney, maybe 15 to 20 years ago, where you could have bought a property within sort of 25 kilometres from the city for around that $450,000, $500,000 mark, then gone and built a granny flat for, let's call it $130,000. So you're into the opportunity at a relatively low price. You're getting the two incomes from the house and the granny flat. Nowadays, 15, 20 years later, those properties are likely worth over $1 million and returning still really positive cash flow. So, you know, timing can be really important, and there's certain opportunities in Brisbane that look really interesting at the moment where you can, you know, target the same fundamentals that have resulted in capital growth longer term, but then get your hands dirty, go in there and manufacture your own cash flow.
I love that, man. Like, we caught up with a client back in 2017, Dave, who'd done 3 of the houses and 3 of the granny flats in Sydney over the last 25 years. All of them were worth over $1 million. All of them were renting for $1,000 a week. And he said, you know, I wanted to do it again in Sydney, but I didn't want to spend, you know, $1 million for the home and $200K for the granny flat. So he engaged us to help him do his strategy in Brisbane. And at the time, I just went, holy shit, like, talking to him, catching up with him for lunch, and really...
It was the little mind-blown emoji.
Well, and I actually went and just completely changed the shape of my portfolio based off seeing it working, because I was always told that you can't get cash flow and growth. If you want cash flow, you've got to buy shitty properties in regional markets or mining towns, and I just couldn't stomach the risk or the downside of that, and it was incredible to see. And so what's available in Brisbane at the moment is we'll buy a bunch of properties this week for $300K through to $600,000 where this strategy is available on, and then in 20 years time they'll be worth more, and that window of cash flow and growth in this city will shut like it did in Sydney.
Yeah, and you're going to have to sacrifice one or the other like we have historically had to do. So there's obviously cons associated with this strategy as well. You know, if we are comparing $1 million property versus a $400,000 property in Brisbane right now, the long-term capital growth for that higher blue chip property is going to be better.
You're going to be further from the city, less average household incomes, lower rents in the suburb, less infrastructure. You know, it's just, there's always a trade between that value gap, whether it's a stock or whether it's a property.
Exactly. You know, it is a bit more of an active strategy. You know, you do have to get your hands dirty a little bit and, you know, add a bit of value to the property, work with builders, work with town planners, make sure that you're buying the property that's going to enable you to do this. Once you understand how to do it, it becomes really simple. But if it's your first time with little experience, it can be quite difficult.
You know, for the people that work with us, that very, very small number we take on each month, we ask them for 15 minutes of their time, and then we introduce them to the right people that can support them and legally help them work through it. For those of you out there doing it yourselves, and I've met heaps of people.
Yeah.
Like in 2019, I went down to Melbourne to catch up with Phil Anderson and did a little talk down there just for the community. And this guy came up to me. Actually, it was in the Sydney event that we did, and he was just like, man, I've done exactly what you boys are doing up in Brisbane. In Sydney myself, I've got 2 houses, 2 granny flats, about to do a third. He's like, I'm loving it. It's so easy. You know, the first one was just getting my head around stuff. But the beautiful thing about being a human is we learn, and there's Google and there's people and there's videos and there's town planners and builders that just do this every day.
Yeah, I think you got to be willing to change as well and adapt, like you did when you had that chat with Dave. You know, you immediately went, light bulb moment, you know, I don't need to hold 10 properties to still achieve my long-term goal. I can do it with 5 or 6.
Yeah.
So it's being willing to change and move with the times as well, which is really cool. But to us, it's not one or the other. It's really dependent on your personal situation, your short and your long-term goals, and then going out there and buying the most appropriate asset.
Without a doubt, like I said, personally working on the buying side of the business at the moment and absolutely loving it. And I would be working with 10 people looking to buy within 10 Ks of the city or walking distance on the beach, the blue chip stuff. And then I'd be working with another 15 people, maybe 20 that are looking at really affordable, high quality housing that they want to do a granny flat on. And it's so cool to be able to do both. And obviously having the experience in my portfolio of owning both, it's just cool. So I suppose for those of you that are interested in this type of idea, whether it's great quality stuff or great quality stuff with strong cash flow, Simon and I would love to offer you a one-on-one strategy session. Just jump over to www.pumkedonproperty.com, click it in. If there's no sessions available, because we only take on such a small number of people each month, and you're really thinking about doing something in the next few months, give us an email that's at the bottom of that page. And Simon or I can talk with you about where you are, where you'd like to be longer term. We can educate you on the market, and then we can talk about some of the real suburbs, the real data points around this. And then you can go and smash it on your own if that's what you want to do. Or maybe you can become one of the people that we take on down the line. But super excited, love sharing this type of info.
Yeah, for sure. And I'm just super excited to be on this journey. And, you know, one thing that we always do during those strategy sessions is help you get a better understanding of which one of these options you should be focusing on next time round.
You know, we love it. And then you can take that back. You can compare it with friends and family. You can talk to your financial advisor, your accountant, and just take that market information into your strategy moving forward. But we appreciate your time. As always, stay safe.
Oh, sweaty. So sweaty.